In a year flooded with Layer 1 hype and meme coin distractions, one silent network could become the backbone of an entirely new financial system. Chainlink. It is the invisible bridge between blockchains and the real world. And in 2025, it might be the most important piece of crypto infrastructure that almost nobody is talking about loud enough. But this is where the story takes a sharp turn. Because while most retail traders are busy chasing narratives that come and go, smart money is quietly doubling down on the one thing that all tokenized assets will need: reliable truth. Let's break down why Chainlink matters more than ever, and what could be next for its native token in this maturing crypto cycle. Let's start with where we are in 2025. Bitcoin spot ETFs are no longer theory. They are absorbing billions in fresh capital from institutional allocators who once dismissed crypto as too volatile or too early. Ethereum staking has become a standard yield product in family offices and hedge funds. Regulation is clearer but also more demanding. Stablecoins are moving under tighter frameworks, forcing protocols to become more transparent or get left behind. Meanwhile, altcoin rotations are heating up again. The US Federal Reserve has already cut rates twice this year. And both the European Central Bank and the Bank of Japan have signaled that quantitative tightening is behind us for now. Liquidity is seeping back into risk assets. But the difference this time is that investors are not just buying coins with catchy memes. They want asymmetric upside backed by real-world adoption. They want networks that can plug into traditional finance and handle trillions in tokenized assets. This is the macro context for Chainlink in 2025. And if you care about crypto fundamentals, this is where things get interesting. So what exactly is Chainlink? In simple terms, Chainlink is the truth layer for blockchains. It provides secure, decentralized oracles that feed real-world data into smart contracts. Without oracles, blockchains are closed loops. They cannot know the price of an asset. They cannot verify whether a bond payment was made. They cannot settle a weather insurance contract based on rainfall data. This is the problem that Chainlink solves. And it is not new. Since launching in 2017, Chainlink has grown to secure over $20 trillion in total transaction value locked. It serves thousands of protocols from DeFi lending to derivatives, from stablecoins to tokenized treasuries. But this is where the story takes another sharp turn. Because Chainlink in 2025 is not just about oracles. It is evolving into a full-scale decentralized computing layer. One that will make it possible for entire economies to operate on-chain, but with real-world inputs and outputs. Let's talk smart money signals. In the last 18 months, venture capital funding in crypto has shifted dramatically. While hype cycles around AI tokens and meme coins grab headlines, the largest rounds have gone to infrastructure. And Chainlink has been at the center of that conversation. Earlier this year, the Chainlink team announced a new strategic partnership with Swift, the global interbank messaging network that handles trillions in transactions daily. They are piloting tokenized assets on public blockchains using Chainlink's Cross-Chain Interoperability Protocol. This is not some theoretical test. Banks like Citi, BNY Mellon, and Euroclear are involved. Meanwhile, venture firms like A16s, Sequoia, and Parify continue to provide grants to projects building on Chainlink's ecosystem. Developer activity is up 12% year over year, even in a cycle where many altcoins saw their GitHub commits drop by half. Institutional adoption is not a promise, it is happening now. But what happens next might surprise you. Because with all this momentum comes a new layer of complexity and new risks. Let's break down some of those risks and sources of volatility. First, tokenomics. Chainlink's native token, Link, is used for staking, paying node operators, and incentivizing data providers. But supply unlocks have been a concern. Earlier this year, a portion of developer reserves came back into circulation. This put short-term pressure on price. Some critics argue that token incentives still outpace organic demand. However, the team has introduced a dynamic staking mechanism. This aims to align token rewards with actual economic value secured. Second, regulatory headwinds. As real-world assets move on-chain, regulators are taking a harder look at data providers. Accuracy, auditability, and compliance will matter more than ever. Chainlink must continue to demonstrate that its Oracle network is not just decentralized in name, but resilient in practice. Third, competition. New Oracle projects are emerging. Some are focused on specialized datasets like climate or carbon markets. Others claim to offer faster finality or cheaper costs. But here's the reality. Network effects and data are powerful, and Chainlink's brand trust is deeply entrenched. Still, no advantage is permanent, which means the team must keep innovating or risk being outpaced by leaner upstarts. So what does the bull case look like? If tokenized real-world assets grow as expected from a few $100 billion today to over $5 trillion by 2030, every transaction will need secure data feeds. Bond yields, FX rates, derivatives pricing, insurance triggers. Chainlink becomes the default bridge for all of it. Staking demand increases as institutions require more guarantees. Developers integrate Chainlink functions, a computing layer that lets smart contracts call APIs and off-chain data. The more protocols rely on Chainlink, the stickier its position becomes. This single decision could change everything. Because once an ecosystem standard is set, switching costs go up exponentially. Now the bear case. If blockchain adoption stalls, or large banks choose private permission chains with internal oracles, demand for Chainlink services could plateau. Token unlocks could overwhelm demand. Regulatory constraints could force node operators to undergo expensive compliance. In that world, growth slows but does not die. Chainlink's core service would still be needed, but the upside would be more muted. In other words, Link would trade more like a utility token, not an asymmetric moonshot. So where is expansion happening now? Multi-chain integration is accelerating. Chainlink has secured partnerships across Ethereum, Avalanche, BNB Chain, and more recently, Polkadot and Cosmos. Its Cross-Chain Interoperability Protocol allows assets to move securely between blockchains. This solves one of crypto's biggest friction points, fragmented liquidity. In 2025, interoperability is no longer just a buzzword. It is a requirement. If a sovereign wealth fund wants to tokenize its bond portfolio and settle trades across multiple chains, it needs bulletproof cross-chain messaging. Chainlink provides that. And the roadmap is clear. More data feeds, more automation, more enterprise integrations. But it does not stop at finance. Energy markets, supply chains, insurance settlements, climate credits, all need verified data flows. Chainlink's goal is to become the trust layer for this new tokenized economy. Let's talk community and governance. Chainlink's DAO model is evolving. It is not a pure on-chain governance system like some DeFi protocols. Instead, it combines community proposals with off-chain advisory councils. This hybrid approach has its critics. But for institutions, it provides stability. The community treasury has grown significantly. Funds are allocated for ecosystem grants, new node operator onboarding, and academic partnerships. In 2024, Chainlink launched a new developer bootcamp that trained over 5,000 engineers to build Oracle-powered applications. Organic adoption is real. This is not a ghost chain. This is a network with a vibrant, mission-driven community. Now let's step back. Think bigger. Tokenized real-world assets are projected to reach at least $5 trillion by 2030. Some forecasts push that to $10 trillion. Either way, the scale is undeniable. And every one of those assets will rely on trusted data. This is not optional. It is existential. Chainlink sits at the center of this. It does not matter if you are bullish or bearish on individual coins. If you believe in a tokenized future, you are betting on oracles. You are betting on reliable truth. And so, you are indirectly betting on Chainlink. So what is the final takeaway? Chainlink is not the flashiest project. It does not trend on Twitter every other week. It does not promise 10,000% returns overnight. But it is building the rails that real money needs. The rails that institutional investors demand. And the rails that make blockchains useful for more than speculation. This is what serious crypto looks like in 2025. Infrastructure, standards, trust. If you value asymmetric bets grounded in fundamentals, Chainlink deserves your attention. If you are a builder, Chainlink gives you the tools to plug real-world data into your applications. If you are an allocator, Chainlink offers exposure to a network effect that is only getting stronger. And if you are a long-term thinker, Chainlink might just be the silent backbone of the next trillion-dollar wave in crypto. But this is where the story takes one final turn. Because the truth layer is only as good as the incentives that protect it. And the next few years will test whether Chainlink's tokenomics, governance, and community can adapt to institutional scale. Stay sharp, stay strategic, and keep wayfaring.